Okay, this is problem 21-24, and it's capital budgeting, including income taxes. Alright, and what you want to do is just have a plan on how you're going to handle these when you get a problem like this. And this assumes the same facts as in exercise 21-23. So we have that one. Here's, oh, that's one. Naturally, it runs away when I get close. 21-23. Except that the city hospital is a tax-paying entity, okay? And the income tax rate is 30% for all transactions that affect income taxes. So they got a 30% tax rate. And the first thing to do is to do all of the different methods. They want us to do net present value, okay? And just for net present value, it's quite a bunch of calculations that you have to go through, okay? Then payback, internal rate of return, accrual accounting rate of return with net investment and average investment. Okay? Yeah. Alright, so let's start out with I'm still looking for 21-23. We can do it without it. Okay, so the investment cash outflow is going to be $110,000, and it's going to reduce operating expenses by $28,000 a year, so that's like a cash inflow, because it's less expense. And then what we would have is less taxes. So that is $28,000 less taxes of 30%. The taxes have nothing to do with the investment here, okay, with the $110,000 out. It's just another fact. So with a savings of $28,000 expense savings is going to cost us $8,400 more in tax. So the after-tax cash flow is $19,600. Okay? But then we can take our $110,000 that there should be another zero here, that we've invested in this, that we've invested in this asset, divided by 10 years, gives us $11,000 in depreciation per year. Okay? And so that depreciation times 30% is $3,300. Alright, so we might have an expense here of $3,300, but it's a tax shield that reduces our expenses by the amount of the depreciation times the rate. Okay? Yeah. Okay, so now we can do our present value, and I don't know, what I was trying to think of a nice way to consistently do it is here we've got the present value is in the first column here, and then the factor, and then years 1 through 10, and we can use this because it's an annuity. Okay, that $28,000 is per year, it's the same amount. So first we've got our cash flow going out. The factor here is really 1.0, okay, and there's nothing for year 1 through 10. For the after-tax cash flow is 102,234. And that's the annual after-tax cash flow, 19.6, times the factor for an annuity, 5.216, is 102,234. Okay, so I've got present value of $110,000 going out, the present value of 19.6 per year for 10 years is 102,234. All right, and the rate, I can't remember. Oh, the rate is, I can't remember what the rate is. But then the depreciation tax shield is also, it's $3,300 a year for years 1 through 10, okay, times 5.216. That $3,300 a year has a present value of $17,213. So here's my net present value is $94.47. All right, and as long as it's greater than, as long as it's a positive number, okay, then it has made the, it met the hurdle rate. It is earned. You would accept the project. Okay, this would be a positive result. No, because it's greater than the discount rate that we had to use, that they're looking for. Now, after-tax payback would be $110,000 as our investment, divided by the annual after-tax cash flows plus the $3,300 in the tax shield from the depreciation. Okay, So our savings, 110,000 divided by, these are just like cash inflows, okay, 19,600 plus the 3,300. So this will pay for itself in 4.8 years. Kind of a long time. The internal rate of return is where the present value of the inflow equals the present value of the outflow. So you reduce that formula, and it's 110 divided by 22.9, which is our annual cash inflows. Okay, it gives us a rate or a factor of 4.803. Okay, that's your factor. So then we go to the table and go to 10 years and look across for 4.803, and it's 16%. Okay, so that would be the internal rate of return. That's what the project returns. Okay, but you really have to look at a few different ways to do this before you settle on one. Okay, then the average or the accounting accrual rate of return, that's 22.9, and that 22.9 is right here. Okay, the annual cash inflows, 22.9 minus depreciation. Okay, so this more or less mimics the income statement. That's what it's like. Divided by the total investment of 110,000. So the accrual accounting rate of return is 10.82%, and that's the average rate that a dollar generates after tax operating income. Okay, then don't forget, with the accrual accounting rate of return, it can be based on either the net investment or the average investment. Okay, it's a V. So if it's based on the net investment, it's just how much you're putting in. Okay, it's one number. This average is like the beginning of the year plus the end of the year divided by 2. It's a simple average. Okay, so just think beginning plus ending divided by 2. Okay, so that 110,000 becomes 55,000, and the return doubles. Okay, 21.64%. Okay, so then the next question is, how would your computations in requirement 1 be affected if the special purpose machine had a $10,000 terminal value at the end of 10 years, and assume, depreciation are based on 110. Okay, yada, yada, yada. What's important here, though, is they're going to get $10,000 at the end of year 10. So what is that going to do without? They just wanted you to answer briefly without further calculations. It would increase net present value, right? Internal rate of return would be increased. Accounting rate of return would be increased. Net present value would have the present value of that 10,000, another 1890 added to it, so that would increase, as you would expect it to. And then the payback period, though, would have no change. It wouldn't make any difference, okay, because it only deals with those first factors. Okay, like this is just how much. It doesn't get down to year 10. This is how much we earn every year until it hits payback, and then we don't care. Okay, so I hope that helps. I could put a PDF just of this up in case you wanted to just look at it, but it's a nice after-tax example. Okay, all right.